There is an old and stubborn law of markets that predates the ticker, the algorithm, and the anxious late-night scroll through financial headlines. The loudest signal is rarely the truest one. And somewhere in the quiet counting houses of London this week, in a market most people could not locate on a map of their own portfolios, something has shifted that the loud signals have entirely missed. Not a headline, not a chart. Something underneath the chart, and if history is any tutor, and it is a patient and unsentimental one, what happens underneath a market usually arrives at the surface long after it has already mattered. Most people, when they think of silver, think of a number. It rises, it falls, it is discussed for 90 seconds on the evening broadcast and then forgotten. This is a perfectly understandable way to watch a market and a perfectly unreliable way to understand one. Price is the epilogue, not the plot. It is the newspaper obituary, written after the life has already been lived. The plot, the actual narrative of a market under strain, is written earlier, in duller ink, in the columns that almost nobody reads. Liquidity conditions, settlement timelines, the willingness of large institutions to hand over physical metal rather than paper promises of it. These are unglamorous words. They will never trend. But they have a curious habit of being right roughly a decade before the headlines catch up. London did not become the fulcrum of the world's precious metals trade by accident. For centuries it has been the place where producers, refiners, industrial buyers, and the quiet custodians of institutional capital settle their accounts with one another, largely out of public view. A city does not accumulate that kind of gravitational pull without becoming, in effect, a seismograph. When the needle twitches in London, serious people do not ask whether it twitched. They ask what moved beneath it. Edmund Burke observed, in a different context entirely, that a great empire and small minds go ill together. One might say something similar of great markets and small explanations. The temptation to explain a strained market with a single tidy sentence is almost always a failure of imagination, and occasionally a failure of nerve. Markets, in my experience, and I suspect in yours, if you have watched them honestly for any length of time, do not announce their transitions with sirens. They whisper. Liquidity tightens by a degree that would be invisible to anyone not standing directly beside it. A settlement that once took a day now takes two. Participants who were once indiscriminate become, without explanation, selective. None of this is dramatic. All of it, taken together, is data. And data, unlike opinion, does not care whether you are paying attention. Here is where the amateur and the professional part company, and it is worth dwelling on the difference because it explains nearly everything else that follows. The amateur assumes markets move on emotion, fear, greed, the evening news. The professional knows better, or has learned better at some expense. Institutions move on balance sheets. They move on funding costs, on counterparty exposure, on the quiet arithmetic of what happens if a scenario they have modeled and hoped never to see actually arrives. This is not romantic. It will not make for a gripping documentary, but it is how billions of dollars actually behave, as opposed to how cable news imagines they behave. Silver occupies a strange and useful position in this story because it refuses to be only one thing. It is bolted into industrial machinery, and it sits in vaults as a hedge against currency debasement, an industrial metal moonlighting as a financial one, or perhaps the reverse. That duality means the silver market is listening to two conversations at once: the conversation about factories and manufacturing output, and the conversation about confidence, currency, and the long-run value of paper promises. When both conversations grow tense simultaneously, as they appear to be doing now, the market does not merely reflect one anxiety. It reflects a convergence of them. That is precisely the kind of convergence that has, throughout economic history, preceded a great many things worth having noticed in advance. None of this is an invitation to panic, and I want to be plain about that, because panic is the least useful response a human being has ever invented. It is instead an invitation to curiosity, which is a rarer and more valuable commodity than silver itself. The disciplined investor, on encountering a strange signal, does not reach for a headline to confirm what he already believed. He asks a duller, harder question. Is this temporary, or is this structural? Is the tremor beneath my feet a passing truck, or is it the ground itself rearranging its opinion of gravity? I will tell you plainly that I do not know, with certainty, which it is this time. Neither does anyone honest. But I can tell you what the institutions who move real capital are actually watching while the rest of the world watches the ticker. Whether liquidity is functioning the way it is supposed to. Whether the cost of insuring against risk is rising in a way that suggests somebody, somewhere, knows something the public does not yet know. Whether the physical chain, mine to refiner to vault to buyer, is running with its usual friction, or whether that friction has quietly increased. These questions do not trend on social media. They are, nonetheless, the only questions that have ever mattered in the long run. History. And I return to it because it is the only laboratory available to those of us who cannot run economic experiments twice, repeatedly demonstrates that the largest financial shifts do not arrive as thunderclaps. They arrive gradually, and then, to borrow a phrase that has outlived its origin, suddenly. By the time a shift is universally acknowledged, the advantage of having noticed it early has already been spent by someone else. This is not a comforting thought. It is, however, an actionable one, and actionable thoughts are worth a great deal more than comforting ones. Confidence in any financial system is the quiet load-bearing wall nobody notices until it begins to crack. Markets function because participants believe, without needing to say so aloud, that transactions will settle, that financing will remain available, that the plumbing of the system will hold. When that belief begins to erode, not collapse, merely erode, behavior changes before statistics do. People grow careful. They preserve liquidity the way a prudent man preserves his reputation, quietly, and before he needs to. This is not evidence of a crisis. It is evidence of adjustment. But adjustment, properly read, is itself a form of intelligence being transmitted from the market to anyone patient enough to receive it. The sophisticated investor, then, does not stare at one dial. He builds what might be called a mosaic: credit markets set beside commodity markets, currency movements weighed against bond yields, inventory data read alongside the pulse of manufacturing activity. No single tile in that mosaic tells the whole story. Assembled with patience, however, the mosaic begins to resemble something like understanding, which is considerably more than most market commentary ever achieves. Risk management, properly understood, begins with the admission of uncertainty rather than the performance of certainty. Too many investors go searching for the perfect forecast when they ought to be building the resilient portfolio, a distinction that sounds semantic until you have lived through a cycle in which the forecast was wrong and the portfolio was all that remained standing. Economic cycles will always evolve in ways that surprise the confident and humble the arrogant in roughly equal measure. The investor's task is not to predict every outcome. It is to remain prepared across several of them, which is a far less glamorous ambition and a far more durable one. And here, before we go further, is where I would ask something of you directly, because the alternative, pretending this channel sustains itself on goodwill alone, would be a small dishonesty I am not prepared to commit. If any of this has sharpened the way you look at the next market that goes quiet before it goes loud, the least costly and most useful thing you can do is subscribe, because the analysis that matters most rarely arrives with advance warning, and I would rather you not miss it simply because the algorithm decided you had wandered off. It costs you nothing. It costs me the ability to keep doing this work if you don't. Consider that the toll for the bridge you've just crossed. Now, the mindset itself, the one that separates those who preserve capital across decades from those who merely accumulate anecdotes about the year they nearly did. Rather than jumping toward dramatic conclusions, the disciplined investor grows more curious, not less. He asks why conditions are changing before he asks what he should do about it, which is precisely backward from how most people are wired, and precisely the reason most people's returns disappoint them. He investigates whether a movement reflects a passing weather system or a change in the climate itself. Above all, he refuses to let emotion masquerade as analysis, a substitution the human mind performs so smoothly that most people never notice they have made it. Patience in this context is not a virtue in the greeting card sense. It is a competitive advantage, and one of the few that cannot be arbitraged away by faster computers or better information, because it does not depend on speed at all. It depends on temperament. Markets reward preparation far more consistently than they reward prediction, a fact that every honest study of long-run returns confirms, and that every impatient trader eventually rediscovers the hard way. The investor who maintains a diversified portfolio, who preserves liquidity as a matter of principle rather than convenience, who evaluates risk with something like a magistrate's detachment, places himself in a stronger position, regardless of which direction the market ultimately decides to move. That is not a hedge. That is simply wisdom, dressed in the plain clothes of portfolio construction. The silver market, in the end, is one instrument in a much larger orchestra, and I would not want to leave you with the impression that a single metal, however storied, explains the whole symphony. But an instrument slightly out of tune can tell an attentive listener something about the orchestra as a whole, long before the untrained ear notices anything amiss. Prices alone rarely tell the complete story. The mechanics beneath them, liquidity, confidence, the flow of capital, the quiet behavior of institutions who have far more at stake and far less patience for theater than the average headline writer, usually matter more than the number flashing on the screen. The greatest opportunities in any market, and this has been true since long before anyone thought to write it down, rarely appear when everyone feels comfortable. They arrive when uncertainty has driven the crowd toward distraction, while a smaller number of disciplined observers continue quietly studying fundamentals in the empty room the crowd has abandoned. Markets are transmitting information constantly to anyone willing to look past the headline. The challenge was never a shortage of opinions. The world manufactures those by the hour. The challenge has always been distinguishing a meaningful signal from the noise surrounding it, and that distinction, more than any single trade, is what separates the investor who compounds wealth across a lifetime from the one who merely compounds stories about the year everything nearly worked out. If there is one pattern that is held constant across every cycle I have observed, it is this. The investors who endure spend far less time reacting to this morning's headline and far more time preparing for a future they cannot fully see. Markets have always been noisy, and they always will be. Every day manufactures a new prediction, a new alarm, a fresh reason to believe the world is about to be rewritten overnight. And yet the investors who consistently preserve and grow capital across decades have learned something the rest of the world resists learning. Successful investing was never about winning today's news cycle. It was always about building the kind of resilience that survives whichever cycle arrives next. Financial markets are driven by expectations, not merely by events, which is a more unsettling thought than it first appears. By the time a headline reaches the general public, analysts and portfolio managers and corporate executives have already spent days, sometimes weeks, quietly working out its implications. This is why chasing headlines is such an expensive habit. You are, in effect, arriving at the theater after the second act has already resolved and asking the usher to explain the plot. Markets do not wait politely for consensus to form. They move the moment expectations shift beneath the surface, well before the public has been informed that anything has shifted at all. Professional investors have made an uneasy peace with this reality, which is more than most amateurs manage. Their focus is not on guessing next week's headline. It is on understanding how a range of economic scenarios might affect a portfolio across months and years, which is a considerably less exciting exercise and a considerably more useful one. Rather than asking what happens next, they ask a sturdier question. Does this portfolio remain durable if conditions grow more difficult than I currently expect? That question, asked honestly and often, has preserved more capital than any forecast ever has. This begins with accepting a fact that a surprising number of investors still resist. Uncertainty is not a temporary inconvenience to be endured until clarity returns. It is the permanent condition of every economic cycle that has ever existed. Interest rates fluctuate, inflation accelerates, and then, eventually, tires. Consumer confidence rises and falls with a rhythm nobody has ever fully explained. Geopolitical events rearrange trade relationships overnight, and technology quietly dismantles industries that assumed themselves permanent. None of this can be forecast with real precision, which is exactly why preparation has always mattered more than prediction. A lesson every generation seems required to learn for itself. Strong portfolios, in other words, are not constructed for ideal conditions. They are constructed to endure imperfect ones, which is the only kind of condition markets have ever actually offered. That means maintaining liquidity as a matter of discipline, avoiding leverage that flatters returns in good years and devastates them in bad ones, diversifying with intention rather than habit, and preserving the flexibility to act when genuine opportunity finally appears. The investor who commits every available dollar during a period of optimism frequently discovers, at the worst possible moment, that he has no capital left with which to act when the valuations he has been waiting for finally arrive. Liquidity in this light is among the most underappreciated strengths an investor can possess. Many treat cash as something unproductive, a resource quietly losing ground while markets march higher without it. But liquidity is not merely an asset sitting idle. It is optionality, the ability to make a decision at precisely the moment others are being forced into one. Throughout financial history, those who retained capital during periods of genuine stress were repeatedly able to acquire quality assets on terms that would have been unthinkable a year earlier. That advantage is rarely available to the fully invested. however impressive their returns looked the year before. Discipline also requires resisting the very human temptation to read every market movement as the opening chapter of some grand new trend. Markets fluctuate constantly because millions of participants process the same information differently and arrive at different, often contradictory conclusions, which is, incidentally, rather the point of having a market at all. Daily volatility more often reflects shifting expectations than any permanent change in underlying fundamentals. The investor who responds emotionally to every twitch of the tape frequently manufactures risk that a calmer temperament would never have created in the first place. Institutional investors understand, in a way the retail investor is rarely taught, that risk management was never about eliminating uncertainty. It is about ensuring that uncertainty, when it inevitably arrives, does not become destructive. They run their stress tests. They model the scenario in which growth slows further than expected, the one in which inflation lingers past its welcome, the one in which financial conditions tighten with no warning at all. None of this guarantees success. It simply and reliably improves the odds of surviving long enough for success to become possible again. Preparation, properly practiced, also demands a certain intellectual humility that pride tends to resist. Markets retain a remarkable talent for humbling even the most seasoned professional, and confidence, rightly placed, comes from process rather than from certainty. The investor who remains open to evidence that contradicts his own comfortable narrative adapts more successfully than the one who has grown attached to being right. This matters especially in periods when the signals themselves seem to argue with one another. One sector flexing strength while another quietly weakens, consumer spending holding firm even as manufacturing cools, employment appearing stable while corporate investment turns cautious. Economic transitions have never unfolded in tidy, synchronized fashion, and the investor who insists on forcing every contradictory signal into a single, simple explanation is usually the last to notice when the story has already changed beneath him. Diversification remains, in this light, one of the most practical philosophies an investor can actually practice rather than merely admire. No single asset class performs well in every season. Equities, bonds, commodities, and cash each respond to a changing economic climate in their own fashion, sometimes cooperating, more often not. Diversification does not promise to maximize any single year's return. It exists to make a portfolio resilient across many years, which is the only time frame that has ever actually mattered to anyone building real wealth. Patience again deserves its due, because markets increasingly reward the appearance of speed while long-term wealth continues, stubbornly, to reward thoughtful decision-making instead. Rapid trading generates excitement, and excitement is a poor substitute for compounding. Many of history's most durable investment successes were built not by reacting cleverly to each day's news, but by holding quality assets through cycle after cycle, while the anxious traded around them. This reframes volatility itself. Rather than a threat to be feared, the disciplined investor treats a market decline as an invitation to reassess value, provided he has kept enough liquidity and enough composure to act on what he finds. Emotional control, in the end, may be the single most valuable financial skill a person can cultivate, and it is taught nowhere near enough. Fear tempts you to sell exactly when prices have become attractive. Euphoria tempts you to buy exactly when valuations have become stretched. Neither impulse has ever produced a reliable strategy, and both have ruined more portfolios than any recession on record. The task, always, is separating the sentiment of the moment from the fundamentals of the long run, a separation that sounds simple and is, in practice, the work of a lifetime. The greatest investment opportunities have never appeared when markets felt comfortable. They arrive precisely when uncertainty rises, and the crowd begins mistaking discomfort for danger. This is held true across every economic cycle worth studying. When confidence is abundant, assets grow expensive simply because everyone insists on owning them. When uncertainty rises, most investors lose their sense of proportion entirely, focused on escaping the discomfort of the present moment, rather than identifying the value quietly accumulating around them. That, more often than not, is where the largest opportunities are actually born, not in the headline, but in the silence just beneath it. None of this has ever required perfect timing. It has required discipline, a far scarcer commodity. Markets swing between optimism and pessimism with a frequency that would exhaust anyone who tried to trade every mood swing, while the underlying economic value beneath them changes far more slowly and far more quietly. Businesses continue producing, consumers continue spending, innovation continues, indifferent to whichever headline currently dominates the evening broadcast. The world is rarely rewritten overnight, whatever the headlines imply. And long-term wealth is built by those who can tell the difference between a passing mood and a genuine shift in the ground beneath them. Rational investing begins with a distinction most people never quite learn. Volatility is not the same thing as risk. Volatility measures movement. Risk measures the possibility of a permanent, irreversible loss of capital. The two are related the way weather is related to climate, connected but not identical, and mistaking one for the other has cost investors more than almost any other error in the history of markets. A temporary decline in price does not mean the underlying value has vanished. Occasionally it means precisely the opposite, that value has simply gone looking for investors patient enough to notice it. History offers no shortage of evidence that periods of widespread uncertainty produce exceptional opportunities for those willing to remain calm inside them. In difficult stretches, strong businesses are sometimes priced alongside weak ones, simply because the market, in its haste, has stopped discriminating between them. Investors chasing immediate certainty routinely overlook long-term value sitting in plain sight. Those willing to actually examine a balance sheet, a cash flow statement, a competitive position, a management team, often find opportunity hiding directly beneath the pessimism everyone else has accepted as fact. This requires patience, because markets have never been obligated to reward correct thinking on any particular schedule. Prices can remain disconnected from underlying value for far longer than most investors are prepared to tolerate, which is exactly why discipline outperforms speed over any meaningful stretch of time. One of the last and perhaps greatest advantages available to any investor is simply the willingness to think independently. Markets are periodically seized by a popular narrative that feels unassailable right up until the moment it isn't. The rational investor keeps challenging assumptions, including, uncomfortably, his own, because understanding the alternative case has a way of sharpening decisions the comfortable consensus never could. Intellectual flexibility, more often than raw confidence, is what actually separates the investor who survives 4 decades of cycles from the one who merely survived 1 good year. Risk management in the final analysis is not about avoiding risk altogether, an impossible and rather cowardly ambition, but about ensuring the risks taken remain proportional to the goals they are meant to serve, and recoverable if they go wrong. Recovering from a significant loss requires a disproportionately larger gain simply to return to where you started, which is arithmetic, not opinion. And it is why preserving capital has always mattered more than chasing the last available point of return. The investment landscape will keep changing. Technologies will keep displacing one another. Monetary policy will keep shifting beneath everyone's feet. None of that is within any investor's control. What remains within your control is how you respond to it. With discipline, with patience, with liquidity kept in reserve for the moment it actually matters, and with a willingness to keep asking the quiet, unglamorous questions long after everyone else has settled for the loud, easy answer. So here is the only real question left, and it is yours to answer, not mine. When the next market goes quiet before it goes loud, and one always does, will you be among those still asking why, or among those who only noticed once it was already the headline? Tell me in the comments what signal you'd be watching for, and whether you think this silver story is signal or noise. I read every one of them, and the best conversations this channel has ever had started in that comment section, not in the script. And remember, this is for education and discussion only, not personal financial advice.